I heard.
How are you?
You can, no.
Good evening, ladies and gentlemen. The mayor has called the pension workshop to order. Mayor Javy,
I am here.
Maybe here.
Councilmember Laredo,
Here.
Councilmember London, Vice Mayor McCormick, Councilmember Moss,
Here.
Councilmember Petros,
Here.
Councilmember Segurola.
Here.
We do have a quorum, even though we don't need it. Please rise for the Pledge of Allegiance.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
The mayor is brief comments by council.
I just wanted to say I hope everybody had a good Memorial Day weekend. I enjoyed I always think it's important that we get out there and we're there for the ceremony. I think it's important that we honor those who have died, basically, to give us the freedoms that we have today. So thank you for those who attended. Hopefully we can get more people attending next year. And I guess my other comment is I just want to reiterate to the police force on this island that when they are enforcing our laws, I want them to know that, at the very least, I don't want to speak for everybody up here, but I want them to know that I've got their back. And if any parent ever feels that the police are overstepping their bounds in enforcing the laws of this village, they are mistaken. That we all have to abide by the laws, we have to obey them, and when our kids don't, they have to be held to account for doing so. So I just want to put it out there for our police officers. Thank you for what you do, but know that the mayor has your back if anybody's going to give you a problem with enforcing our laws.
I think you could say the whole council. I mean, that's something that we have asked to happen. So if it did, I don't know what you're referring to, an incident, but I agree with you.
No, I don't think it was an incident that one of us didn't. I think just we want to
Put it out there.
Yes.
second that.
Anybody else? Okay, let's move on.
Next item, mayor's public comments.
Anybody want to make a public comment? And we will, during the presentation, we're going to allow people to come up and ask questions. Just raise your hand. This is pretty informal. So let's get going.
Next item, special presentation by Christopher Wallace, interim CFO.
Take it away.
Good evening. We've been asked to put together a presentation on pension plans, retirement plans in general, not really specific to the village per se, but to try and meld it in the concept of the village's plans and mostly the financial planning for the village. So with that, and bear with me, I don't usually use Windows laptops with all this stuff, so if I mess this up, not really sure where it's supposed to show up at. All right, it's showing up on my screen, so there are, okay.
Give me 1 second.
We'll take our commercial break now and come back.
This is what you're going to have on.
Yes, sir.
Is there any reason, Madam Manager, why we can't get this before the meeting starts?
Yes, that was on my office's side, so I apologize for the delay. Moving forward, we are going to try to get material out with at least a weekend in advance of any workshop, so we're working on doing that, being better.
Also, in fairness, I was late getting it to them because I made some changes. It turned out he didn't have the most recent pension plan changes, so I had to go back and reincorporate that to make sure we had what was current. So there's two basic types of retirement plans. Most of you are familiar with them. There's a defined contribution plan, which the village has, and there's a defined benefit plan, which the village also has. In a defined contribution plan, the accounts are maintained for each participant. They're usually individual accounts. Both the employee and the employer typically pay into these accounts based upon fixed contribution amounts. The account assets are invested at the direction of the employee, but can be limited by the employer. And the benefit paid to employees upon retirement is whatever's in the account at the time of retirement. And almost always, the risk of these plans is on the employee. So sometimes you can do better or worse depending upon circumstances compared to a defined benefit plan. A defined benefit plan is what people would consider to be the traditional retirement plan. It provides a guaranteed benefit at retirement, usually a monthly payment. The benefit is a formula based upon age, length of service, and salary of the employees. Annual contributions to the plan can be changed based upon events. Benefits cannot be paid while still employed, and the risk of funding usually falls upon the employer. Defined contribution plans must be qualified plans under the Internal Revenue Code, as would defined benefit plans. Otherwise, the contributions to the employees would be taxable and would not be tax deferred. The contributions wouldn't be tax deferred. A plan that falls out of disqualification will have the assets held by the plan immediately taxed. Plan assets are segregated and not available to creditors in either of these cases. In both cases, they're generally not subject to federal ERISA requirements. This is often a confusion, particularly for divorce attorneys, in my experience. And the benefits or what's ever paid out is taxable to the extent that they weren't already taxed, and they're usually not. So when you take a distribution, you're going to be taxed on the payment that you receive, whatever form that is.
Chris, can you explain what ERISA is?
ERISA is, in general terms, it's a federal law passed many, many moons ago that governs how pension plans will operate under federal oversight. So it's a tax code provision. There are concepts like highly paid employees, which don't really apply to government. There's the concept that you can't make an election that affects your pension benefit unless your spouse or significant other agrees to that. That also does not apply to governmental pension plans. There's certain tests that are made as far as how contributions and benefits are paid out. Most of these are geared towards making sure that pension plans are fairly administered, do not benefit highly compensated employees, and have no discrimination towards other employees regardless of their status in the plan.
But it's not just pension plans, it's also contribution plans, right? It's both
It's
defined
both
contribution and defined benefit?
Yes, it's for both retirement plans, defined contribution plans and defined benefit plans.
If I can add, what happened was Pennsylvania Railroad went bankrupt in 1970, and people who were retirees were shit out of luck. And as a result, the government came in and basically this was, for lack of a better word, to make sure that people who had money in a pension plan would be able to collect something. Not necessarily, as Chris said, highly paid employees might not have got the full benefits, but lower paid employees did get benefits, and the government was on the hook, so to speak. So as a result, once they became on the hook, they then also were able to regulate pension plans, which they didn't do before. Is that correct, Chris?
Yes, and there was a lot of, back in the 70s and 80s, there were a lot of game playing with pension plans, unfortunately. So the government stepped in to protect the employees and also the public purse. Unlike private plans, that the defined benefit plans have to pay an insurance policy actually to the federal government in case they go out of business. So you have a government agency that actually levies, basically a tax on these types of plans to make sure that there's money in case they go belly up. Governmental plans do not have that as a general rule. It's not even really a necessity.
So we don't have an insurance plan to protect ours. Is that accurate?
Well, you're not paying into like the FDIC. It would be the equivalent for a pension plan, and it's not going to cover all benefits. It's going to basically, usually it's paying out a reduced benefit, but it's some sort of safety net, if you will. But it doesn't, you still want to manage the plans in a safe manner. So in Florida, I would just say up front, Florida has very stringent rules and oversight on defined benefit plans. So I really wouldn't lose too much sleep over how they're managed. The state will definitely make you run these in a fiscally responsible manner. Something that can be available in defined benefit plans is what's known as the deferred retirement option plan. These became popular in the 90s, I guess, and all it is an in-service distribution without constructive receipt, meaning the employee retires from the employer, in this case it would be the village, They continue working for the village for up to 5 years, and they actually retire from the plan. They do not receive their monthly annuity or whatever form of retirement that they took. Instead, that money is set aside or put into a separate account. And at the end of that 5 years, the employee can withdraw it, roll it over, do whatever they want with it, but they have to leave employment during that period of time, no later than generally 5 years. So drop plans, the employee just cannot touch the money during that period of time. What the employee gives up when they go into the drop plan, it's not something that they need to take lightly, because they do give up future raises, and in the case of a defined benefit plan, the future multipliers. So their retirement benefit may actually be higher in many plans than if they had waited those 5 years. But some employees, for many different reasons, like to enter what's called the drop plan. Once they enter, or once they actually leave employment of the city, they no longer have their money going into the drop plan. That retirement check, if you will, gets paid to them directly. So then it's like a normal retirement payment, if you would. So funding considerations are the same in both of these. You want to make sure the benefits that you're providing are sustainable. In a defined contribution plan, generally the employer contributes a fixed amount of money. There's no guesswork to it from year to year, although that amount can change if you so elect. Also, the employee generally contributes a fixed amount. In governmental plans, these tend to be 401 money purchase plans. Believe it or not, there are some old governmental profit sharing plans, but not too many of them. I don't know why they even have them. The profit is something that's kind of anathema to government, I think. It's usually in the defined contribution plan, it's usually a function of the salaries or wages. The investment earnings belong to the employees. They're usually self-directed by the employees through many types of mutual funds or a series of investment types. Employees are only entitled to their vested amounts. So vested is a property right concept. Many times an employer will immediately vest you, meaning it's always yours from day one. It's always yours from the first month, from the end of the 5th year. There's all sorts of types of vestings. A cliff vesting is nothing more than after, say, 5 years, you're 100% vested. Up to that point, you don't really vest. Step vesting is basically you get 10% a year for 10 years as an example, and at the end of the 10 years, you're 100% vested. And so that vesting amount, let's say you're 50% vested, whatever in your account or whatever benefit you have coming to you, you're only going to get paid 50% of it if your vesting's 50%. So there's an incentive for people to stay longer. That's the intent of vesting. So employees don't come in and just immediately leave and take the pension contribution that you put aside for their benefit with them. Employees are always entitled to a refund of their contributions. Well, I say always. We'll get to that in a minute. Under Florida law, if you commit a crime that's really a crime against the government that you work for, you could forfeit your public benefit. Defined benefit plans, typically the employees pay a fixed percentage of their pensionable earnings. Now, pensionable earnings aren't necessarily their salary and all their other earnings. There may have, in governmental plans, there may be earnings that don't count towards their pension. There's sometimes a limit on the amount of overtime that will count. Educational incentives, car allowances, that type of thing are generally not thrown into the pensionable or the pensionable earnings, but they do show up as total earnings for the employee. The employee generally makes up the actuarially required differences from year to year, meaning that generally speaking, the employer's contribution can fluctuate up or down depending upon experience and other things that happen in the plan. The investment income on the employee and the employer contributions help fund the benefits to the plan. The employee is only entitled to a benefit that has vested. That sometimes can be less than 100%, as we discussed in the other type of plan. Payments cease when the employee or other person entitled to the pension dies. So sometimes the normal form of retirement is usually a single form of annuity or with a certain amount paid out maybe over 10 years. But you can choose the actuarially equivalent of that amount and provide for a spouse or other forms of retirement. But they continue until a death occurs as a general rule in a defined benefit plan. And an employee, once again, is always entitled to their contributions during a refund when they leave employment of the employer. Florida's Constitution requires that government-defined benefit pension plans be funded on an actuarially sound basis and that future taxpayers are not stuck with the current taxpayer's bill. So what that means is if Joe's working for the city, current taxpayers should pay for Joe's cost of his pension plan and not stick it to someone 10 years down the road. That's both in the Constitution and it's also in the state law. And how you determine that is by doing a study every year or periodically, generally every year, looking at how well the plan does and trying to figure out what's the contribution supposed to be today to fund this plan. Keep in mind, and this is really important, people forget this, at the end of all the time when employees cease working and have retired, you will pay what you will pay. The benefits that are accruing have to be paid out. At some point in the future, if the city ceases to exist or the plan ceases to exist, the last person who's vested and entitled to a benefit will get what they're entitled to. So while you're talking about annually is the timing of a contribution and the estimated amount that's currently due that benefits the employees currently working and in the future, but is what the taxpayers should pay towards the future benefits. It's kind of an accounting concept called the matching principle, but it's also an exercise that the actuaries go through to comply with the sound funding principles and also the legal requirement in Florida. I know everyone reads newspapers and sees how bad pension plans do, and they're always worried about underfunded or unfunded pension plan liabilities, and I'll get to that in a minute. But I would like everyone to keep in mind that what happens in Illinois, particularly in some places in California and elsewhere, they do not have the same type of safeguards that Florida has. And it's unfortunate because in a state like Illinois, a lot of times what they do is they just budget and pay for the benefits that have to be paid out that year. So what you see consequently is in a state in Illinois and the city of Chicago and places like that, their budgets have skyrocketed and they pay basically a lot of money for pension plans that should have been set aside years ago. And the states there, Illinois and some of the cities in Illinois are really trying to extract themselves from that because they have a really tough time making these funding commitments and it constrains their budgets. And this was done 30, 40 years ago, and the cumulative effect of that has really buried these cities, and they have a right to be worried, but they should never have done it to begin with. Even if it's not a law, it's a bad financial practice because it's sticking someone else with your bill, essentially. So
We do the same thing. We do this exact same thing, but to a different degree. When we were $5 or $7 million of unfunded liabilities, actually calculated unfunded, we basically said, fine, we have 30 years to make that up, and we're $6 million in the hole. So each year we're going to pay $200,000 to make it up in the next 30 years. So we do go into the hole. We are not fully funded. I mean, last year, I think the last union contract threw us, I think, $5 million in the hole. So immediately we then we're trying to reduce it, I think, from 30 years to 20 years. So then each year we're going to take $250,000. So yes, the people for the next 19 years will pay that $250,000. So it is cast on to future taxpayers, not to the same extent like you're talking about the massive unfunded things they have there, but in fact, we all have, most all places have unfunded liabilities because we don't contribute normally enough, or we assume we're going to make more of the money than we actually make on our investments. So we were pretty close before the last contract. I think we're down to $1 million or $2 million, but I haven't seen it lately, but I think we're up around $5 million now.
Yes, the latest valuation is imminent. It would have been nice to have it before this, but the timing just didn't work out. But you're right. I mean, I'm not going to argue with you on that because it is right, but at least Florida and most places require you. Yeah, if you were worried about having an unfunded amount, you probably would never establish a defined benefit plan to begin with because you wouldn't be able to afford it. And that goes for private plans as well as public plans. You know, typically and I actually think that happened here, you start off and you don't really have a pension plan or the type of pension plan you want. Time goes on and employees start to work and you reach a point where we can afford it and you want to keep and retain employees and you want to reward those employees that have worked with you for so long. And if you didn't take that accrued unfunded liability and amortize it over time, you may not be able to come up with the $5 or $6 million at one time to be able to do it. And you might be forced to go into, say, a defined contribution plan where you wouldn't have that liability. And that's choices people make. But you're right about that. I mean, to some extent, it adds to the timing and pushes the cost down the road. I think it's admirable that you want to do 20 years instead of 40, because I always thought 40 was kind of a ridiculous number. It makes it more affordable, but it tends to mask the liabilities that you've just assumed. So it is true, but I mean, it's also the nature of the beast to amortize it to some extent. But Florida allows that. They don't feel like it's really shifting too much of the burden of the plan to the future taxpayers. And they virtually all start off that way. And anytime you change the benefits, you have that amortization scenario going on again.
Chris, I thought you told me when we were speaking not to worry so strongly about unfunded liability, and
I look at plans. I don't care that much about the unfunded liabilities. I care that you're funding the plan on an actuarially sound basis, like Florida requires. I care more that I look more to see what an employer is contributing to the pension plan than the unfunded liability. The unfunded liability, even if you were 100% funded at one time, if you have a bad day in the stock market on the day of valuation, you're going to have an unfunded amount, and that's just a temporary anomaly. I mean, you may have an unfunded amount just because you changed the benefit, but it's kind of not really a good measure of if your plan's being run well. I think a better measure is and reflection of the benefits paying. How much are you contributing as an employer towards the pension plan? I think that's a better acid test of what the plan's costing you. I mean, you need to delve into the plans, and particularly when I'm looking at plans in other states where I'm not so familiar with how they're supposed to be funded, you can run into some interesting calculations. But I'm real comfortable in Florida that those plans tend to be pretty well managed and with pretty good oversight by entities outside of the boards and the elected bodies that appoint those boards.
The one thing, of course, is you try and not, as Chris is saying, if you look at one particular point in time, all of a sudden you're going to see that you're unfunded. So it really is better to have 3 or 5 year moving average, because you're going to have the good years, the bad years, and you don't want to start oscillating crazily. So you try and do that before you make your adjustments. Hello?
Yeah, you want to definitely. I like
here?
smoothing those things because it does. If you don't, you can get some wild things.
Grace, may I ask you a question? Sorry.
No, I was turning this stuff.
I'm very happy that Ed spoke in plain English, because most of the taxpayers and people who are watching us, sometimes this language is a little bit beyond even I. But look, his comments brought me back to a comment. Again, we have pages, Madam and Mr. CFO, without page numbers. I don't know why we do these things here, but funding requirements, I don't know what page that is, but if you go to that page, and I quote, you say the Florida Constitution requires that the government defined benefit pension plans be funded on an actuarially sound basis, and that, quote, future taxpayers are not stuck with current taxpayers' bill. Could you explain, as I understood his comment, and I was a taxpayer, it's an everlasting contingent liability as a taxpayer.
Well,
unfunded pension funds are a permanent liability, potential liability of the taxpayers.
okay, well,
Would that be a correct statement?
I would change that word from unfunded to underfunded, because unfunded.
Okay, underfunded.
Yeah.
But
are they perpetual? They're only perpetual in the sense that until the last employee gets their last check, then it ends. Until then, it's pretty much forever. But there comes a time, maybe 1,000 years from now. But
no, Chris, I'm not that far away.
Okay.
I'm maybe not explaining myself well. The statement that future taxpayers are not to be stuck with current taxpayers' bill as per the Florida Constitution, I don't think it sounds correct to me. because it's a contingent liability out there for underfunded or whatever term you want to do in perpetuity.
Well, the underfunded portion is usually being, a large portion of the underfunded amount is being amortized. So maybe I can make it akin to when you borrow money. If you borrow money, let's say you borrow $10 million today, and this is the extent, the status is the extent of the people who have to pay it back, that $10 million is going to be paid back over time, the principal and the interest. But who created it was this current body, if you would. So you're benefiting from that. But future taxpayers will also pay, principal and interest on that bond. So that happens there as well. It's kind of like an unfunded liability. You really haven't set money aside to pay off the principal and interest. It's just come and due at different times. But I think your overall point is correct. These are to be viewed as very long-term commitments, and they're in many ways the worst kind of debt because they don't go away, and there's nothing to show for it in a tangible sense at the end of the day. If you borrow money and build a bridge, well, you have a bridge you can point at and say, all right, well, I got a bridge for my $10 million. These monies represent the services that employees provide. And once the year ends, those services are gone and you start it all over again.
But my point is for our citizens, taxpayers, is that this is a very, 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 very serious part of our governance.
It absolutely
and
is.
And it affects our budget, affects their possibility of contingent liabilities, and we should not take it lightly. That's, as one of our major responsibilities, as we call them our shareholders that we represent here. That's my whole point. Because
and it's a good point to make, because you can burden future taxpayers, future residents by doing the wrong thing sometimes. And you have to tread lightly and cautiously with these types of pension plans because typically the liability rests upon you. And they are expensive. They can constrain your budgets. They do constrain budgets. During the recession, you heard people of every political stripe at the local level complaining how their budget's already constrained by a downturn in the economy, already reduced property tax values, looking at increased pension plan costs because their investments have also gone south, and now the pension plan is more underfunded than it was. It does constrain your budgets. It can very easily constrain your budget in a very short period of time, and usually at a time where your budget's constrained for other reasons. So it's a double whammy that can occur and does occur with some regularity. So I totally agree with you that it is very important to understand these issues. I think that's kind of why we're here tonight, and to and plan for them and incorporate them in whatever long-term financial planning that you do as a village, because it does constrain you. I guarantee you that the two things that you will do as a local government is you will pay bondholders, you will pay the pension costs that you're obligated to do, and then if you have any money left over, you can turn on the lights, because it's going to go in that order. You're not going to be able to walk away from these. You can do everything, you can do anything you want after you do those two things. So I don't want to make it sound doom and gloom. These are manageable items if you manage them. And it takes everyone to manage them, both the elected officials, the management, and the employees. So in Florida state, the state can force local governments to put additional money into the pension plan if they don't. They're not very, they can be patient, but they want you to do the right thing when you're supposed to do it. We do conduct actuarial valuations annually to determine what our funding should be for the ensuing years. And there are assumptions that are used in determining that, and we'll get to that in a minute. Now, you have something that's unusual in your plan. Like I said before, most of the time, the risk of these plans falls to the employer, whoever adopted the plan. But you have a fixed level of 20% that the village will not contribute any more than 20% of the pensionable costs into these plans. You don't generally find that in local government plans, and it's a really big constraint that helps you plan better. So I think that's a good thing. It had been 14% and now it's 20%, but it's still constrained. I would tell you it's not unusual to see pension plan costs in South Florida be 40, 50, 60% of payroll. I've seen one plan that was 100% of payroll. So every dollar they earned, they got another dollar that had to go into a pension plan. That's mostly reflective of the benefits provided in those plans, but there aren't too many private employers that could afford to pay, 60% of their payroll into a pension plan and still compete. And it constrains their budget. It puts pressure on property taxes, and it's just a fact of life. So tread lightly. Cities in Florida also receive money from taxes levied on commercial insurance policies. These are sometimes referred to as Chapter 175 monies, Chapter 185 monies, or just plain chapter monies. The money comes, as most grants do, or most government revenues, with some strings attached. Those strings are that the money has to be used to provide benefits that are greater than those generally given to other employees. You have to annually demonstrate compliance with this, or the funds will not be distributed to the village. I think this has actually happened in recent memory, where it was delayed and then you had to pay it back. And then this last one, and this is why when in governmental finance, what we look at is intergovernmental revenues, or money you receive from other governments. The more money you receive from other governments, to us as finance professionals, is actually a risk, because you're not in control of that revenue. And if the entity that's giving you that revenue changes how they give it to you and you don't get it anymore, well, then you're just out of luck. Back in the 1980s, prior to that, there was a federal program called Federal Revenue Sharing, and the government changed it, and they basically eliminated it. And you would have thought the world was coming to an end, because cities all across America were used to getting this money, and it helped them in their budget. But the world didn't come down to an end. Cities found the money themselves. But if you think about it, when you get that money from another government, they make the rules, and if you don't comply with it, or they just say we're not doing it anymore, then you're out that money and you have to make it up. So that's always a risk with these chapter monies. Now, they have never changed them before, but keep in mind this is insurance on commercial activities in the village. So as values go up and people insure their property for more money, the premiums go up, but the converse is also true. If properties go down for an extended period of time, property owners may say, you know what, I don't need $2 million of coverage, I only need $1 million, then those premiums will be less and you will get less. So the village complies with all the statutory requirements for these chapter monies.
I don't know if this is true in other organizations, but for those of you that are new up here, it wasn't that long ago that we as a village weren't able to use the 175 and 185 money towards our contributions, but it was kept within the fire department and the police department. And the state made a change. Do you know what year it was, Chris? But that's a benefit. That was a benefit to us. And so therefore the village didn't have to contribute as much, or hasn't in the last, I want to say 5 years. And you should know that, because we didn't have that benefit before that.
So annually, when these valuations are done, they're estimates. They're estimates of what your costs will be, what your revenues will be, and they're based upon assumptions. And those assumptions are key and need to be looked at, because if they're not reasonable assumptions, they can change the timing of the payments and either require you to pay more now or pay more later. And there's many assumptions, but the three key ones that I think that I would look at is your investment return rate. And this is the rate of return that the plan is assumed to achieve on all its investments. Currently, your plan is 7.7, reducing down to 7.5. Back in the 90s and early 2000s, it's very common to see pension plans with 9% assumed rates of return. I've actually seen these rates of returns manipulated by both the employer and employee groups to either provide more benefits or, try to reduce benefits. But they should be what are reasonable, and they should be done and changed infrequently. But, every once in a while you'll go through and you'll look at your plan and do a historical study on where you should be. The second biggest one is the pay increase assumptions. What do you assume that the employees are going to be earning over time? How big were their salaries increased from year to year? Because keep in mind, in the defined benefit plan, One of the biggest components is the average final compensation. So the bigger that number, the compounding can actually be a pretty big difference over time. So that makes a big difference in pension plans. And then mortality. So one of the things as finance officials that we like, or not like to, but kind of worry us, is the old mortality tables that were predicated on things that they existed in the 70s or 80s. And we believe that people will be living longer, even though currently there's a little dip in the age. We think people will live longer, and the longer they live, the more you pay and the more it costs. It's as simple as that. So those are the three key assumptions that we think you should focus on. Other assumptions are, how fast do people retire compared to what we're assuming? How fast do they leave the employer without retiring? How many of them get disabled to what actually happened? The cost method is an assumption that is not as manipulated as it used to be, and other minor considerations. The point is there's a bunch of assumptions that go into determining how much you pay and how much the employees pay from one year or one valuation to the next. But the big one is the earnings rate assumption. And actually in your financial statements, there's a whole section that we devote to the sensitivity of what that means and how much it can change your accrued liability by 1% plus or minus. And it's, it can be a staggering number if you look at it. So this, I'll hammer down this first point. At the end of the day, you're going to pay what you're going to pay. Until that last check goes out, the plan is a determined amount at some point in time. So you're really just talking about the timing of the payments. Everything that's owed will be paid, and the valuations and assumptions only determine the fair timing of the funding for the plan. On stewardship, pension plans are set up as separate trust funds with oversight provided by a separately appointed board. Here, for instance, and it's not unusual, it's pretty typical, the board's a mixed board of police and fire benefits. So you have one member who's a police officer, one who's a firefighter, 2 council appointments, and then a 5th appointed by the other 4. And they are charged with taking the plan document and administering it in a fair manner, both to the employer and to the employee participants. So they wear 2 hats, and what's before them as a plan is what they're supposed to administer. Not a plan that they want, not a plan that they had, but the plan in front of them. So the plan determines the benefits and determines how the plan is operated. They do this without interference, hopefully, from village management or elected officials. The board cannot change benefits or expend any funds in an attempt to study benefit changes, or they shouldn't. And the plan benefits are at the sole discretion of the village council, but can be affected by union agreements. So obviously you can't just change benefits that are covered by a collective bargaining agreement. You have to negotiate them. But at the end of the day, the elected body is the one that has to adopt the plan. So you pass an ordinance and you amend the plan. Plans also, you submit them to the IRS for plan qualification. You get a determination letter to make sure that you do comply with certain rules. I mean, there are some ERISA rules that do govern governmental plans, but you do want to always take your plan and have the federal government through the Internal Revenue Service issue a determination letter to make sure that it is a tax qualified plan, and yours is.
Does that happen once, or does that happen every year? How often is it?
Well, I think, well, if you change the benefits, you should either get a pension attorney to opine that it doesn't need a determination letter, or just send up and get another determination letter. I mean, for your plan to be found not qualified and have a determination revoked is a really big problem. It could ultimately wind up that you'll just wind up in lawsuits with employee groups at that. So it doesn't hurt to get a determination letter. So I would encourage you to do it. But sometimes you make a change that's just not, I wouldn't worry about it. Depends on what the change is the short answer.
Who triggers the request for that letter? Us as a body?
Yes. You as a body, I believe it's something that the village should do. The plan could do it itself. Someone should do it, but you're adopting the plan. I would get the comfort of having a determination letter for any plan that you adopt or any significant plan that changes the benefits. It's going to be an evaluation of the benefits in context of the laws that are being applied to it. Pension plans are extremely long-term obligations of the village and its taxpayers, and also its employees, I should have put in there. We talked about it. In many ways, they're more constricting debts than issued for projects. Because projects and debt have a limited duration, pension plans more or less go on forever. Pension plans are invested generally in securities and investments that are volatile. Now, they can go up and down from 1 year. And because of that volatility, the contribution amounts can vary widely from 1 year to the next or from one valuation to the next. And that makes financial planning sensitive to these plans. So usually when you're doing long-range financial planning, we look at a range of assumptions on how the pension contribution for the employer affects the long-term finances of the village. Employee groups will continue to want better benefits or reduced contributions in defined benefit plans. That's just a given. You will be compared to others. You will be compared to yourselves. But as a general rule, employees will always want more, and the elected bodies will always be under pressure to try to manage that in context of what the plan expenses should be. Your plan is a very well-funded plan. This may surprise some people, but overfunding a plan can actually be, for both private and public employers, a risk. And it's a risk that a lot of people don't consider. When you have an overfunded plan in the private sector, something may happen that all of a sudden, now you have an underfunded plan and you're going to have to raise your contributions as an employer, which means having more expense on your income statement. And your pricing of your products may be such that it's going to be hard to adjust to that. So, you may have problems there. But on the public sector, what you may find, and I've had this happen several times in my life, where a plan's overfunded assets are then used to provide additional benefits to employee groups. They usually starts as the wish of the employee groups. They'll make a representation that we can use these excess assets and fund these benefits, and it won't cost you anything because we're using excess assets. And on paper, and as far as it goes, that sounds good, but what happens is now you have less assets. And keep in mind, all those assets were being accumulated for the purpose of paying off employee benefits over a long period of time. At the end of the time, you're not going to hit it exactly on the head, but at the end of time, all those benefits will be paid. So this money is being put away to pay for the current benefits, not for benefits that don't exist. So when you have an overfunded plan and you give benefits that are paid for with those excessive assets, if you want to call them that, the overfunded status, that's a liability that you're pretty much going to be stuck with forever. And the first downturn in the stock market or something may happen, and now your plan's overfunded, and you're stuck with those liabilities, and now you're going to have to come up with more assets, which is going to basically mean more contributions, generally from the employer. So when you start seeing an overfunded plan, and you may be getting there, we'll see after this next valuation. The last valuation that I'm aware of, you were highly funded. You weren't overfunded, but you have given away additional benefits and negotiated them. So I would expect that percentage to decline. It might be mitigated with the improvement in the stock market, but we'll see here in a week or two when the valuation comes in. But keep in mind, if you get overfunded, that may be cause for celebration, but it's also, in my opinion, a time for caution. I've seen that happen too many times, and it's one of the reasons you see pension benefits currently in South Florida, 40, 50, and 60%. They used overfunded plans and paid additional benefits. And then the market soured, and now they're stuck with the liabilities. Employees and the public often misunderstand or mischaracterize what their benefits are or how the plan is funded. You'll often hear employees refer to a plan as their money. The plan provides benefits that are in part funded with employees' money, but they're in part funded with taxpayers' money and the investment income on that. All that money is going into a trust for their benefit. and it's important that their benefit be properly funded. But it's also true that a large portion of that money is a result of taxpayers having helped fund the plan. So it's everyone's money set aside to provide a benefit for your employees. And as we mentioned before, it's a trust between the village and its plan participants. Both parties have a financial interest in the plan. As an employee, you don't want to see a highly underfunded plan. You don't want to know that and have to stay awake thinking, am I going to have pension benefits? And they shouldn't feel that way. It's a promise that's been made to them. They've earned it, and that they should be paid for it, and they should have comfort that their plan is being well managed. This is also true to the extent a board spends any money on management or any kind of study or anything that's not really going towards paying the benefit. It can really be looked at in most plans as another dollar that's going to have to be paid by taxpayer. So you really need to make sure that the boards are managing your pension plans, but not spending money excessively. And typically that doesn't happen. I say typically because it does happen from time to time. You're fortunate that you have a young plan that provides generous benefits at a very reasonable cost compared to most of the public safety plans, particularly that are out there. I think it's more important to control the benefits and the employer's contributions than to worry about it, how funded or underfunded it could be. I mean, you need to look at it, but like I said before, I would be more concerned with how much you're contributing. Annual funding in Florida is about the timing. At the end of the days, it's going to be paid. And contribution rates are a very good proxy for what you're paying into it. There's a tremendous interplay in pension plans and the collective bargaining process. And there's also, in my judgment, sometimes problems with that. As you go through the collective bargaining process, pensions often proposals are brought up. And you have to understand the cost of those as an employer, as the bargaining group, and also as a board. But you may, as a body, approve a collective bargaining agreement, but you have yet to adopt the plan amendment, which you've already agreed to. So then you come back and you adopt the plan amendment, but preceding that, you have to have an actuarial valuation impact statement that shows how much the proposed plan amendment is going to cost everybody. And you can run into a little bit of a wall having, particularly if an elected body's change, where one elected body approved a collective bargaining agreement, and now the new body doesn't want to approve the pension plan change. So then you have unfair bargaining, you have lawsuits. The point is you need to coordinate these very thoroughly during your collective bargaining process and understand and commit to what the costs are. So before you agree on a pension plan and a collective bargaining agreement, and I don't know that you've done this or not, but I've seen it done, without understanding the full cost of that pension plan change, you really shouldn't ever agree to anything unless you know what it costs, and pension plans would be number one on that list. So the Government Finance Officers Association of the United States and Canada actually have some best practices on how pension plans should be operated. And these comments, these notes are actually for defined benefit plans. Pension administrators and finance professionals consider key plan design elements, plan funding, plan governance, and the risk management and participant education. And that's generally well done for most plans in Florida. Under no circumstance should state and local government plan sponsors engage in pension contribution holidays or make insufficient contributions. You will actually find that in several states, and actually in some states you'll find it in some cities. They don't have the same rules for some of the same cities. But Florida law prohibits this. You have to contribute what you're supposed to contribute. So rest assured in this state, I don't think that's generally an issue. Local governments that offer defined benefit pensions should formally adopt a funding policy that provides reasonable assurances that the cost of these benefits will be funded in an equitable and sustainable manner. Well, Florida law, again, requires this, so I don't generally see this being a problem. Local government officials should ensure that the cost of defined benefit pensions are properly measured and reported. Once again, this is nothing new for us in Florida, but it does happen, in other states, but not here. Local government retirement systems establish within their overall investment policy and asset allocation plan. Florida rules govern this, and you have that. So an asset allocation plan is considered by your boards. It is recommended that retirement systems, especially those that use alternative investment strategies, adopt an investment management fee policy that allows the retirement system to negotiate the lowest competitive fee possible while looking out for the system's long-term earning potential. I'm not saying I can't address this one way or another if your plan does this, and I think it's kind of dealing with something that's generally outside the investments that a plan of your size has, but it's definitely something that you would want them to do. Last thoughts, not every state has the same rules. I hate to pick on Illinois and California, but they generate most of the press, and they should bear most of the blame for how people perceive government pension plans. Pensions are a major benefit to employees, and they should be assured that what they've been promised will be paid. You need to understand how these plans work. The risk they represent to local government finances is important, not just for you, but into the employees themselves. They often forget that they have skin in the game, and a poorly managed plan could hurt them as well as you. Misunderstandings can cause ill will and lawsuits, so it's important to communicate with people and they understand stuff. I mean, I think you had one at the last meeting that you had to deal with, and it's unfortunate, but I've seen that many times, and you know, the misunderstandings and the miscommunications can be very costly. We'll emphasize that Florida has very good laws and oversights on local plans, particularly police and fire plans, to ensure that they are well managed and properly funded, and that the current taxpayers pay their fair share without shifting too much of the cost burden to future taxpayers. I will also say most of the hand-wringing on Florida plans, when I've had to discuss how they affect certain finances in cities, has been after the cows left the barn. You know, it's enough to whine that you're paying a lot, but there's not a whole lot you can do about it once you've already adopted a plan amendment. You're going to have to fund it, and you're just going to have to suck it up and take your lumps. Unfortunately, sometimes that happens to an elected body that didn't make that decision. So you may always keep the future in mind. So proceed with great caution when improving benefits. Pensions are not bad things. They are not. They're valued benefits by employees, and they help attract and retain employees. Pensions can represent tremendous financial exposure to you, but prudent stewardship can avoid catastrophe. That's not just for the board, that's for the village council in this case to also take the time to understand pension plans, your pension plan, how it affects your long-term and current finances. And they work best when employees, retirees, and the employer work together to strike a good balance between the benefit and the cost. So proceed with caution, education, and financial understanding when considering these benefit changes. And I know that's a lot and kind of boring in many ways, but just they are very important, and I commend the council for even taking the time to have a workshop to have these ideas presented, and I'll be glad to answer any questions that you may have.
Councilmember Moss?
I have two questions. One's direct and one's indirect. The direct one is, do we know when our next negotiation will begin? And the indirect one is, what is the process of the negotiations, when they need to start, when they need to be decided, and what happens if you don't come to an agreement? Well, it's like 4 questions.
So
Put it all
next year we'll start negotiations.
When you say next year, you're saying January 2020?
So I think on our side, we'll start internally looking and reflecting at what's working, what's not working. We planned on starting that in the fall. So September, October, once we get through the budget adoption process. And then with regard to impasse, may actually be a Chad question, but I'm sure Chris can answer as well.
As far as what?
The impasse if there is an agreement reached.
And it's every 3 years that we must negotiate? Is that how our system works?
I think we're on a three-year cycle.
Okay.
So I think what happened last year is we were a little bit late, so some of the plan went retroactive to prior years, which is why it was a little bit difficult for us to sort of reconcile the impacts in a particular year because the allocations were over 2 prior years.
So if we're on time, the idea is that we would have something negotiated in 2020.
Right.
Based on, okay.
That's the goal.
And I'd also point out that a lot of times you hear that we're working without a contract, but that's kind of disingenuous. The existing contract remains into effect until it's changed. So there is a contract that's binding upon the employer and the employees while a new one's being negotiated.
Councilmember Petros?
First of all, thank you for putting this together for us. Secondly, I wanted to know, you mentioned multiple times all these safeguards that the state of Florida has, and yet there are still pensions in the state of Florida that have large funding requirements that would appear to be due to some mistakes potentially. And how do we reconcile those two facts?
Well, I don't think they cross. I think they are the same. There could be many reasons why you have high pension contributions by the employer. In my experience, it's a reflection almost always of the benefits being provided to the employee group. And as a council member noted, you start giving a benefit and then you fund that additional benefit over 20, 30, 40 years, the unamortized cost of that liability instead of paying it all at once. And that has the effect of increasing the employer's contribution over time. And then it's not static. Every time you go into negotiations with employee groups or you want to extend benefits, you do it again and you do it again. And when plans are largely funded, I mean, I don't think you really saw anyone coming in during the recession, or the Great Recession, or when things were bad, asking for additional retirement benefits. What you mostly saw are people hanging low and a lot of layoffs. But when things are bad, I don't tend to see that. It's when things are good that you start seeing, you have additional revenue, the tax base is increasing, the plan's overfunded, whatever. There could be times where bad decisions are made by a board. They did poor investments, and maybe they lost a lot of money. That happens for sure. People sometimes don't measure risk in pension plan investments, which is always astounding to me. Because I tell them, I got two funds. They're my Las Vegas family of mutual funds. One's the Double or Nothing Fund, and one's the Let It Ride Fund. And the Let It Ride Fund's been doing really well for the last 6 years, but I got the dice in my hand, and I'm going to roll it. So you're either going to have more, double, or you're going to have nothing. And I use that generally in pensions as an illustration of the risk involved in them. So they need to consider risk in the plans, and they do make bad investment decisions sometimes. But I think that tends to happen in large plans where they start needing to expand their asset allocation out of traditional stocks, bonds, and that type of thing, and they start getting into things a little bit more exotic that maybe they don't understand so well.
Wes, I'm sorry, Wes Pritchett had a question, and then I'll come back to you.
I just wanted to make a comment because one of the biggest.
Please come to the
Yeah, come to
podium
the podium so that
and state your name.
can all hear you.
Sorry to interrupt, but I just think it's important for them to hear this, is that one of the biggest mistakes, my name is Wes Pritchett, most of you I know, some of you I don't, but one of the biggest mistakes that council members like you are going to face when you deal with pensions is that you're going to be in collective bargaining and you're going to look at it as a static position, because invariably one of the biggest mistakes that you'll make is that you'll view this as the bargain for this period of time, and you'll do the actuarial tables and it'll all look great maybe for your assumptions going out 20 years or longer. But you fail to take into fact and the consideration that you're going to be looking at a new bargain and a new increases every 3 years. So every time you go to look at that, if you think of it as a static negotiation, it's not. And that makes a lot of contributions and pension plans become a little less acceptable to deal with over time. So there's a bunch of things. And by the way, the other two things in the presentation about the age and the increasing the needs of the employees and the age of retirement are two other factors that you really need to pay attention to actuarially, or you'll get upside down rather quickly. And I've seen this many, many, many times. So anyway.
Thanks, Wes. Councilmember Laredo?
Thank you, Mr. Mayor. Chris, first of all, this excellent presentation.
Demoted again.
Thank you for it. I've had a lot of experience both in public and corporate pension funds, and I just want to, and I can get lost in this forest because there's a lot of terminology and a lot of stuff. We just saw that you agreed to some changes on what I consider contingent liability, and I'm very happy, Mr. Presley. I never met you before, but your comment struck. It's okay. I appreciate that. I think that your short presentation expresses exactly how I feel. I ran for this thing, and people voted for me like yourself because I take very high regards for the taxpayers' money. And we just had an unfortunate, and today has been very politically correct. I tend to be more blunt. And Chris said that the last week we had a settlement because, quote, there's misunderstandings. So the misunderstanding cost us $325,000. However you feel about it, the point is, it's like, while I'm here, I'm not going to have misunderstandings about the pension fund. And that's why earlier I made the point to the taxpayers who are watching us that this is very important. This is not something, and your phrase about short-term comfort, particularly in a small community, is a very false comfort, and I'm going to be on the watch. And having said that, and congratulations for being picked as a new member of the board, I wanted to go back to planned stewardship because in essence of the people who are here, there are only two who really are new. You know, even though we have 4 new commissioners, councilmen, 2 have been before. So I want to be able to, and I understand plans, so don't waste. I just want to talk about Key Biscayne and planned stewardship. So perhaps you can, are you versed on that? I know that you're new, or the manager, because I want to understand the system of managing.
Yeah, I'm not totally familiar with it, to be perfectly honest with you. And we were trying to also, under the advice of your labor attorney, not to be too specific with the comments here, so it doesn't look like we're negotiating. But I don't think your comment is along those lines.
No, I'm very focused on.
Councilmember, perhaps you could give us some questions
I
if
will.
we didn't answer.
I'm thinking how to, now that you told me, I'm thinking how to put it so we don't get into. It seems to me, who's the watchdog here? I mean, what is the period of time that lapses between managing this thing? I know that the board of the trust is immediately responsible, which delegates almost entirely, as we delegate to them, they almost entirely delegate to the financial advisor to run this thing, or 3 of them? 3 people. Right, I'm thinking of you call it the investment manager, the professional that you all hire. That's one company, right?
One individual depends on who that is.
Okay, and how does that individual become accountable to the board? No, I love to have you because I like to learn. I'm not
going to educate you at this moment because I just wanted to make another statement that's real kind of important for me as being in this position, which I volunteered to do. And I think
you'll
this will
regret.
I love Key Biscayne. I love all these guys too. I know most of them for a long time. But one of the things that I need and that I would require is, and I'm sure you can, because I can't ask any intelligent questions or make any really intelligent statements until I have this information. I need to see the fund's rules and the governing structure and the documents. I mean, the organization charts, the board policy manual. I need to see those things. I need to know if there is, all this information is online so that I could see it. Basically, I need supporting documents on the agenda. And the other question that I was going to ask, I think it just got answered for me, was are there any outstanding litigations against the village as far as the pension plans are concerned? Because those are things that I would like to know as well, and how they would be, how I would look at dealing with them. So, but if I can have that information, I could come back to you with all the answers that you need for all of those other questions. But I need that information first. So just for my own edification, it'd be greatly helpful if I have that, and then I think I could be helpful to you. So thanks. Thank you.
Yeah, because without picking on the composition of your presentation, you know, on the one hand, they do this meaning the management company and the board without interference from the village management or elected officials. So that leaves me with a question, well, what is interference? Interference, is it the flip side of responsibility? I mean, I'm more concerned about the responsibility side. So we don't have more misunderstandings that can cost us money. So, I mean, that's probably beyond your scope of your presentation, but.
Well, I can speak in general terms on some things that all plans in Florida have to do. They can choose their investment managers, 1, 10, however many they want to choose. They can determine their asset allocation model. But one thing they have to do is they have to have an independent monitor, someone who reports on the investment performances and whether or not they're meeting the goals that were set by the board, usually with the assistance of the investment monitor. So they do have to pay, and I think it's money well spent, for someone to come in quarterly or however often they do it and say, okay, we expected this return and you were here, you know, or this was the asset allocation and things changed, so we rebalance. They are required to do that, but make no mistake, when you set up a trust, that board is the one who's going to have to administer it. And if you feel that they've violated their fiduciary responsibility as the council, just like an employee who would feel if they were violated and didn't get the benefits that they were entitled to, then you're going to be, you can apply pressure, you know, saying like, I'm going to put new board members on. So you have 2 board members that you can put on and appoint, but it's still the minority of the board as a whole. And you do need to look over their shoulder to see that they're managing as well as they can. And I don't know that they are or they aren't. I suspect they are. It's rare for me to see a pension plan that really isn't, maybe I wouldn't do it the way they're doing it, but at least they put their heart into it and educate themselves and have professionals to guide them.
Well, I don't want to take up the time of the other colleague said. Now I got an early sense of comfort having met Wesley, that perhaps the best thing is to, since we have him and a new one coming up, to come back to this issue later on so that I can understand better. I'm more concerned with the accountability and the short-term, not short-term, but more periodic supervision. I don't know what the word is I'm trying to be, well, rather than the big surprises. So I think I get it. And maybe after you get your things together and a new member, then I can
Luis,
come back.
the other thing you should know is every year, their actuarial advisor creates a full report that shows how it's done, and we look at all of that. And the reason there's this separation is we set policy, as you well know, and then they go and they administer for the pension itself, and it needs to be separate. They can't make policy decisions, and we can't make investment decisions. And,
no, I understand that.
Yeah.
I understand that perfectly well. I'm just trying to make sure at least they get from me that I am, and I'm more concerned after last week. So settlement. So I just want to get the mechanics right, and I don't mean to imply that we want to quote interfere.
Well, and I would say that issue really has nothing to do with this discussion of that part of things.
Yeah, I think that issue was a council issue at hiring, the contract.
I understand, but it arose out of what he termed misunderstandings. I think.
How do we get a copy of that last report for the last year?
Oh, you have to make the request of the clerk. Actually, you could get it for him, right? The actuarial report of the pension. It's available.
The other thing I would add, Councilman Loretta, it might be useful if the pension ordinance that we have is circulated to the council, so you can read the specific powers and responsibilities.
I have read it.
Oh, you have? Okay.
Yes, sir. I read before I get here.
Okay.
The other thing, Chris, that I thought was very helpful, at least for me to understand the ramification of the long-term investment, is I think of it as a mortgage. And then anytime we make changes to this plan, because you're spanning it over 30 years, and when we make changes, it's like a modification or a new mortgage, and you're setting the clock for the next 30 years. A refinance, yeah.
And I would just emphasize that your appointments
This is the one you
have
gave me in
meaning.
1997.
You know, if you put someone on a board who really doesn't understand their duties and jobs and doesn't take the time to educate themselves, you'll be the ones to pay for it, because those are your two appointments. The employees get the other two, and then those four choose the fifth. So your appointments, you know, should be meaningful.
Can I ask a quick question, though? Because I think Mr. Pritchett asked for a lot of information and where he should be getting that information, and I don't know the answer to that. Does somebody? Can someone tell?
So Chief Lang and I were just speaking about that. So I think it's possible that it exists with the plan administrator. It is possible that it might need to be dusted off and refreshed. So we'll work on seeing what's available and provide that to you, and I'm sure you'll have some useful insights for the board.
There's just a standard best practices that I'm aware of that I have used, and they should be followed so that the board members can actually make sure that we're implementing to the best of our ability the plan that whatever the council has set forward.
Right.
Like I said, we're not negotiating, or we're not involved in any of the bargaining or the plans. We have to be fisher responsible. The only way we can do that is we have really clear guidelines.
Clear rules, right?
And you guys should all be wanting to see all of that as transparent as possible.
And as we were talking, I'm thinking there might be some opportunity to define certain metrics, perhaps, that get reported back to council. I don't know if that's common practice or not. I don't know if that's being responsible or interfering.
Well, no, but let me give you an example of, I've responded to our council that I have read the 25 pages of the resolution several times. It's underwritten. And now it turns out that it's a 1997 version. Now, I only got elected, and I got it after I got elected. So 1997, I must have had some amendments, but I, as an elected official, was going on this. So but what was that movie? We have a failure to communicate sometimes with documents here. Cool Hand Luke, I guess it was, Paul Newman. So would you start by telling me which is the last one so I can read the last one as amended by?
We'll circulate it.
Okay.
All right.
Can I ask one more question?
Certainly.
What was the percentage of just curious, what's the percentage of the plans that the village has that are defined as opposed to contribution?
You mean DBs as opposed to DC?
I don't know the answer to that question percentage-wise or dollar-wise. My guess is that it's largely weighted towards the DB plan for two reasons. That's where most of the employees are, and that's where most of the expense of the payroll is. And then the benefits there are probably more generous than the defined contribution plan. If I had to guess, it's probably 3 to 4 to 1.
I think that's about right.
That's what I would have thought. I just wanted to-
Thank you all. If there's nothing else, I'll move to adjourn.
Second.
Okay, we're adjourned.